Next speaker is Dimitri Zenghelis, and as Dimitri takes the platform, just a few words of introduction of him. Patrick Holden was asking me earlier on, could I characterize the audience for him, and you'll be hearing him speak a little later on today. And I find it quite difficult because many of you are hybrids, many of you are mutants, and Dimitri is an example, in the best possible sense of the word mutant. And Dimitri, I would say, is one of those. So he ran Lord Stern's office for the review on the economics of climate change. He's Cisco's chief economist for climate change. He's a visiting fellow or researcher at the LSE Grantham Institute on climate change. So many different hats. Dimitri, the floor is yours. And the theme is green growth, if I remember well.
Thank you. Thank you, John. I've been called many things in my time. I don't think I've been called a mutant yet, but it's always refreshing to get a new label. Now, let's see, first of all, if the technology works. Yes, there we go, that's me. And I'm going to do something that's probably quite rare these days in this current environment. And I'm going to say that we're actually, at the moment, presented with a golden opportunity. We really are in a breakthrough moment. But I'm not convinced, or I'm going to argue that this opportunity will not last all that long. So if we don't move quickly, we do risk wasting it. And the starting point is investment. This is a story that we're all pretty familiar with. Investment, whether it be business or public investment, has pretty much tanked across the rich world. There are two charts there, show the US and the UK. Why has investment tanked to pretty much record post-war levels as a percentage of GDP? Well, put very simply, the business world is very nervous. It's not confident in future demand, so it's holding back on investment. It's retrenching. And it's putting its money, because there is money, and that's going to be a key part of the story I'm going to tell, somewhere else. Where is it putting its money? Well, actually, we're not in an environment, much as people might have you believe, where there's a shortage of private money. Quite the reverse, in fact. Net savings, that's the difference between saving and investment, have actually risen to record post-war levels in most of the rich world. And that's what these rather complex, busy charts over here show. Let's see if I can, yes, I can point, fantastic. They basically show net borrowing, net financial balances, the difference between investment and saving amongst basically the two sectors in the economy, the private, which is the blue line, and the public sector, which is the red line. And these are accounting identities, right? They don't show causality. But you'll immediately pick up a sort of symmetry effect here. The difference being the green line, anything that the private sector doesn't borrow from the public sector or vice versa, a country has to borrow from abroad. And that's shown by the green line, which is the current account. So, but, that's stayed pretty flat. But within that story, we've seen these vast gyration in net financial balances. And to sort of simplify a little bit, what we see happening in 2008, 2009, where you see this jump in private sector saving to record levels, was effectively the financial crash. The private sector realized that it had overextended itself, that assets were overvalued. There was a stock adjustment, a necessary stock adjustment. And as part of that process, households, businesses, and banks tried to rebuild their net worth. They did that by spending less. They did that by retrenching credit in the case of banks. They did that by cutting investment in the case of businesses and cutting jobs as well. The problem is that is a perfectly rational reaction from the point of view of an individual. If you feel nervous about the economic climate, you want to save a little bit more. That's the right response. But when everybody does that simultaneously, the collective consequence of that is self-fulfilling. The very recession you're worried about becomes predetermined by the fact that everybody retrenches. It's what economists call the paradox of thrift. And it's pretty much the situation we're in. The red line, of course, is the public sector balance, which went the other way. If nobody's spending and jobs are being cut and nobody's earning and profits are declining, revenues collapse. And also welfare payments go up. So the public sector picks up the tab, if you like, of that stock adjustment. So we're familiar with the deficit story. But what people tend not to talk about so much is the net saving story. Where's all this saving gone? So I'm characterizing a world where we're flooded with private saving. Well, it's clearly not going into physical investment, right? We saw that from the first chart. So where do these billions of dollars of global savings go? Well, they mostly go to the safest possible places, the assets that are considered as close to risk-free. They tend to be government bonds because future taxpayers will be able to cover them in those countries that appear solvent. So we're not talking Greece, but we are talking the US, we are talking the UK, we are talking Germany. And to take the US, the biggest bond market, these are Treasury forward yield curves, and they basically show interest rates on US government bonds in nominal terms going all the way through to 20 years. Now, the staggering thing about this is that they're below the expected rate of inflation pretty much through to the end. So in other words, real risk-free interest rates the world over are less than zero. They are negative. The money your pension funds are squirreling away into these safe assets are making no returns for you. Sorry about that. It's entirely perverse that we're seeing negative real interest rates at a time when there's so much requirement for investment. It's almost tragic to see that. And the reason is very simple. You've got this huge amount of savings being dumped in these instruments. You've got no investment, so desired saving exceeds desired investment, and interest rates fall through the floor. This isn't a reflection of a collapse in the global return of capital for 20 years. We've never seen anything like this before. What it reflects is a lack of confidence, the very foundation of the paradox of thrift that I was talking about. So this is the kind of trap, this is the kind of disequilibrium that we are stuck in. Why am I arguing then that this is a fantastic time to move forward, both in stimulating the economy and laying the foundations for the kind of green transformation that we need? Well, very simply, I'm going to argue that governments can do an awful lot just by sending a very clear, credible signal of their commitment to transforming the economy into a green, sustainable, resource-efficient economy. Why? Well, twofold. I believe that sending this clear signal is enough to stimulate vast amounts of private investment, which yield positive returns for investors and do something useful. Firstly, because we know that this is something that has to happen. We will have to make the transformation to a green economy. So it's long-term credible. In fact, I challenge you to think of a sector, whether you believe in climate change or not, I challenge you to think of a sector that's likely to be more successful over the next century than resource efficiency. We're seeing a huge growth in the middle class in developing countries, particularly in Asia, and we've got a relatively finite set of resources, not all of which we can substitute out of. Actually, energy is one of the easier ones because we can substitute out of fossil fuels into renewables. So however it happens, whether it happens through prices of raw materials or whether it happens through a policy environment, this is a growth area. Businesses know that. What they don't know is whether the credible policy commitment to get them through the next few years will be forthcoming. But in a way, in this nervous economic environment, that is the advantage of this sector. Because if you do send a clear policy signal, then investors can actually move knowing, for example, if you've got carbon prices or standards and regulations or you support renewables and energy efficiency, that's going to change everything. This is transformational. It's going to change buildings. It's going to change energy supply. It's going to change efficiency. It's going to change the way cities are designed, and so on and so forth. And that is going to change behavior. You're going to have to innovate. You're going to have to invest. You know what the end point is going to be, but government is also going to help get you through these crucial next few years. And that's the important part of this. And of course, this has to be seen as an investment cost. The previous speaker, David, was absolutely right. To look at this in terms of these static, comparative static input-output model type or general equilibrium models, which economists are fond of, is precisely the wrong way to look at this. This is about a transformation. It's about inducing innovation. It's about the dynamics of a system. It's about changing the system. It's not marginal this or marginal that. It's a complete redrawing of the economy. And now is the time to do it for very clear macroeconomic reasons. Resource costs are low. We just saw that. There's very little crowding out taking place. If you were to move to a green economy 5 years ago, green investment would have to crowd out alternative investment. Green jobs would push out alternative jobs. Am I over time? I think I am, so I will wrap up. Just one example of this. That hasn't come out very well, so I will skip over it. Just to say that this is an extraordinary and rare opportunity. We're talking here about a win-win scenario. You can not only create a lasting legacy for a transformation of the economy into something that's sustainable and allows us to have the kind of growth we need, because business as usual growth is simply going to snuff itself out, but you can also create the jobs, create the investment, and create the economic stimulus that helps you get through the current economic turmoil with very little call on the public purse, by the way. Standards and regulations are not particularly fiscally demanding. In fact, carbon pricing and carbon trading can actually raise revenues. You'll need to support some of the risk in order for the policy to be credible, and that's what this chart would have showed. But if you can do that, you can generate the kind of economic activity that you really need to restore fiscal revenues. So, as I say, this is an extraordinary opportunity. There is no shortage of private money out there. What there is a perceived lack of opportunity, and there's an awful lot that I think governments can do to change that. But if they don't do it quickly, that window will close, and I think in 5 years' time, if we haven't taken that opportunity as a society, we will look back and we will really kick ourselves. Thank you very much.